If you're not preparing for the next rate hike, your money is already falling behind. Because while most people react after the fact, the smart ones position themselves before the Fed makes a move. And here's the truth. The next rate hike could either cost you thousands or unlock your next big financial leap. It all depends on what you do right now. See, every rate hike sets off a chain reaction. Loans get pricier, mortgages tighten, stocks reprice. But also, savings accounts, bonds, and strategic plays become way more profitable. At the end of this video, you'll walk away with 3 tactical money moves you can make right now. Moves that could save you thousands, grow your wealth faster, and even give you an edge most people won't see coming. Don't worry, these are not complex hedge fund strategies. You don't need millions, you don't need to be an economist. You just need to act with clarity, while everyone else waits and hesitates. Let's start with the first money move. And this is one of the fastest ways to protect your cash flow before things get tighter. Tackle high interest debt, especially if it's variable. Now, if you're thinking, I don't have much debt, I'm good. Take a second look. Are you carrying any credit card balance? Do you have a personal loan or maybe a line of credit with a floating rate? Because that's where the real danger is hiding. Most credit cards in the US now hover around 20% APR. And that number spikes every time rates go up. Which means your balance, even if it's not that high, becomes a compounding nightmare. Let's break it down. If you have $8,000 on a card at 19%, that's over $500 a year just in interest. And if the Fed bumps rates again by 0.25%, you're looking at even more bleeding, quietly, every single month. The mistake most people make? They keep making the minimum payment and ignore the impact. But what they're really doing is throwing away money they could be investing. And here's where smart strategy comes in. You have a window of opportunity before the next hike. Use it to refinance. Look for lower rate personal loans. Use a 0% balance transfer card if your credit is solid. You can freeze the interest for 12, sometimes even 18 months. That's time. Time to pay aggressively without losing money to interest. And it's not just about saving money. It's about regaining control. Because every dollar you're not paying in interest is a dollar you can invest. And when rates rise, there will be new opportunities to invest smarter. But only if you're not chained to bad debt. Wealthy people hate paying interest on liabilities because they understand this simple rule. Cash flow is power. And debt that grows faster than your assets, that's not just a setback, it's sabotage. So before you think about investments, crypto, real estate, start here, clean your balance sheet. Because in the next section, we're talking about how to actually profit from rising rates, and it's something most people ignore, to their own regret. While rising interest rates can feel like a threat, they also unlock one of the most overlooked opportunities in personal finance, earning more on your idle cash. Because for over a decade, we've been living in an era where savings accounts gave you nothing. 0.01%, 0.05%, maybe 0.10% if you were lucky. People just got used to the idea that putting cash in a bank was basically the same as letting it rot. But everything has changed. Right now, thanks to tighter monetary policy, some high-yield savings accounts, money market funds, and short-term treasuries are offering 4.5% to 5.5% APY. That's not speculation, that's guaranteed yield. No volatility, no risk, no stress. The problem? Most people are still parking their money in checking accounts earning 0%. Or they're letting their brokerage cash sit uninvested, basically leaving free money on the table. And that gap adds up fast. Let's say you're holding $10,000 in cash for emergencies or short-term goals. At 0.01%, you'd earn what? At 5%, you'd earn 500. That's literally 500x more, just by switching where the money sits. Now imagine you're holding $30,000 in dry powder, waiting for the next market opportunity. That's $1,500 a year in passive yield, without lifting a finger, all while keeping full liquidity. But it gets even more painful when you think about time. If rates stay elevated for the next 2 or 3 years, which is highly likely if inflation stays sticky, then the opportunity cost of idle cash becomes massive. We're talking thousands of dollars in lost interest for doing absolutely nothing. It's the easiest money you'll ever make, and yet most people ignore it. Why? Because it's not exciting. It's not a big trade. That's exactly the point. It's safe, it's smart, and it works quietly in the background while you focus on bigger things. And here's the deeper play. In a high-rate environment, every dollar you don't optimize is working against you. Inflation is still eating away at your purchasing power. And if your cash isn't growing at the same time, you're moving backwards. Slowly, quietly, but surely. Smart investors are already shifting their cash into higher yield vehicles. Not risky assets, just smarter allocation. Think treasury bills, short duration bond ETFs, or FDIC-insured online platforms like Marcus, SoFi, or Ally. Even platforms like Fidelity or Vanguard now offer money market funds yielding close to 5% with daily liquidity. And if you're holding cash inside your brokerage account, many of them let you auto-park that cash into these instruments. It's effortless. And if you're wondering, but what if rates drop later? Good. That's when you lock in longer duration yield. You shift from short-term to intermediate bond ladders or CDs. But while rates are still high, your cash should be hustling. This is also the perfect moment to rethink your emergency fund. Most people treat their emergency fund like a sacred pile of money that must sit still. But what if that $15,000 cushion could generate $60 a month in interest? That's a free Netflix subscription, a gym membership, or your internet bill, fully covered just from interest. And it goes deeper. Some platforms now offer automatic sweeps. Your cash is moved into yield-bearing accounts without you even thinking about it. You get the safety of FDIC insurance, the liquidity of a checking account, and the interest of a bond fund, all in one. We're entering a financial phase where cash is no longer trash. But it's only valuable if you put it in the right place. You don't need to take on risk to make your money work. You just need to stop being passive with your liquidity. Because in this environment, even your safe money can build momentum. And the difference between being intentional and being lazy with your cash could be the difference between financial stagnation and acceleration. And this leads us to the next, more advanced shift, where you don't just preserve value, but start unlocking hidden upside. And in a high-rate world, this move might actually surprise you. When rates rise, most people run from the markets. They assume stocks will crash, real estate will freeze, and opportunities will vanish. But here's the truth. Rising rates don't kill opportunity, they reveal it. They separate speculation from value. They force weak assets to fall and give strong assets a discount tag. That's where the real investor wins. Not by panicking, but by shifting strategy. Because high interest rates shake the tree. They bring volatility. They expose companies with weak cash flows. They hit over-leveraged players and reward the ones with pricing power, strong margins, and solid balance sheets. And if you know how to read that environment, you can position yourself in assets that are suddenly undervalued, but fundamentally sound. Let's break this down. When the cost of borrowing goes up, companies that rely heavily on debt, and especially growth stocks with little profit, tend to suffer. Their valuations get compressed. Their projections become less appealing. And Wall Street punishes them. But not all stocks are created equal. Companies with strong free cash flow, low debt, and stable earnings often become safer bets in a high-rate climate. They don't need to borrow to grow. They generate enough internally to fund expansion, pay dividends, and even buy back shares. And guess what? Those companies often trade at a discount during rate hike cycles because the market overreacts. This is where you focus on quality over hype. Think dividend aristocrats. Think energy and utilities with regulated pricing. Think infrastructure, healthcare, and even certain tech giants sitting on mountains of cash. In other words, look for resilience with upside. This kind of investing isn't sexy, but it works. It's about durability, not drama. While the crowd chases the next big thing, the smart investor accumulates solid businesses at temporarily depressed prices. Now, let's talk about something that used to be boring, but is now incredibly powerful: fixed income. For years, bonds were a joke. Who wanted 1% yield when inflation was running at 4 or 5? But now, the bond market is back. Short-term government bonds are paying 5% plus with virtually zero risk. Corporate bonds and preferred shares are offering 6% or 8%, and sometimes more. And here's the kicker. When the Fed is done raising rates and eventually starts cutting, those bonds will gain in value. So you're not just getting paid while you wait. You're sitting on potential capital gains when the pivot comes. If you build a bond ladder right now, you're locking in a stream of predictable cash flow, something that was nearly impossible just a few years ago. And you're protecting yourself against reinvestment risk by staggering maturities. It's an elegant strategy in a noisy world. But there's another layer: muni bonds. Municipal bonds, especially if you're in a high tax bracket, can offer tax-free income that's equivalent to 7 to 8% taxable yield. That's a huge deal if you're optimizing post-tax returns. And then there's real estate. Not the overheated speculative kind. I'm talking about public REITs, real estate investment trusts. Yes, they've taken a beating. Yes, rising rates have hit the sector hard. But that's precisely why there's opportunity. When entire sectors get re-rated because of macro headwinds, and not because of fundamental weakness, you get mispricings. And that's when you step in. Logistics REITs, residential REITs, and healthcare-focused real estate still have solid fundamentals: long-term leases, steady demand, and inflation-linked rent escalators. And many are trading well below book value, with yields north of 6 to 8%. You're buying discounted income streams backed by physical assets. And when rates plateau or start to fall, these REITs could see sharp upside. Plus, you collect monthly or quarterly dividends while you wait. This is how professionals think. While everyone else sees uncertainty, they see repricing. And repricing creates access. Access to assets that used to be expensive, now available at 15 to 30% discounts. Access to yield that used to be unthinkable. Access to long-term upside with less competition. Because here's the ultimate truth. Interest rate cycles come and go. But those who adapt before the pivot, they win. Not just by surviving the storm, but by being positioned perfectly when the clouds clear. Think of it like this. Every rate hike sets up the next rally. Not immediately, but inevitably. And when the pivot comes, whether in 6 months or 18, those who prepared will be holding the right assets at the right price. Everyone else will be chasing the rebound too late. So this isn't about guessing the market. It's about positioning. Right now, clean your balance sheet. Make your cash work harder. And lean into income, quality, and mispriced value. That's how you stay calm when everyone else is nervous. That's how you play offense while others hide in defense. And that's how you build real wealth. Not when things are easy, but when things are uncertain. If this video helped you think differently about the next rate hike, hit like and subscribe so you don't miss what's coming next. And drop a comment if you want me to break down exactly how to build a bond ladder or screen for undervalued REITs. Because the sooner you move with strategy, the sooner your money starts working smarter, not harder.